Joining us now is Zach Riaz from Banyan Tree Investment Management. Zach, good to catch up with you as we round out the end of 2024. Look ahead to next year. There is a question of whether perhaps if you're just investing in Australia, you're missing out, particularly exposure to the US.
Look, philosophically, it's such a great point. And it's a discussion we've actually been having for the last, since we actually started Banyan Tree. But given you as an Australian investor already have so much exposure to Australian assets through your jobs, through your house and whatnot, I think for Australian investors, when we see portfolios where most of the bulk of risk assets exposure is then backed in Australian assets, Australian equities, you really are missing out on some seriously great returns overseas. But it's just not great returns. But you think about the Australian market, materials and bank sector, there are so many different economic models, business models, not to mention the innovation that's coming out of other parts of the world. For us, globally is where you absolutely look. But Andrew, I'm sure plenty of discussion is already been having around the US exceptionalism and whether that's got more room to run. Because just because you're going global, it doesn't mean you just go, there are challenges in the global economy as well. So I want to just show a couple of charts around why we are still very cautious, despite the big disparity in valuation, despite the big disparity in returns between US and ex-US global equities, is that the first chart is the financial depth index. And I think everyone knows US markets are deep and the most liquid, and that's where everyone wants to be. But I think this chart sums it up. I think it's put out by IMF. It takes in a bunch of indicators, one being market capitalization as a percentage of GDP. But you can just see how far ahead the US is in terms of its depth. And look, when things are going haywire, you want to go to where there's certainty. And look where Europe is. Even China is higher in terms of market depth. So when you look at that chart, for investors who are worried about what may be happening geopolitically, what may be happening from a tariffs front, and we were just talking about off-air in terms of the political issues that are happening in Canada. I think Justin Trudeau is potentially being ousted. And then obviously what's happening overnight in Germany as well, no confidence vote. And then you've got the strong US dollar. Then you've got the innovation of Silicon Valley. So I am not suggesting that you go headstrong in US equities. All I'm suggesting is we need to see genuine, good policy shifts in other parts of the world for investors to confidently and on a sustainable basis move capital out of US and into other parts of the world.
Yeah, I see you make the point there that so the US innovates, China replicates, Europe regulates.
Not my saying, but it's a great quote. And that's the issue. And that's why people still gravitate towards the US. And the other big point is, I think this is an indicator. So if clients want to know when to shift to global equities, to play, even if it may be for a short-term basis, that disparity in valuation between US and ex-US, look at global trade. I think that's, if you actually chart ex-US earnings growth on top of MSCI ex-US index, you will see global trade is very important. And the simple fact is, outside of the US, a lot of the markets, Australia, UK, and Europe, they're cyclical markets. They really rely on global trade and global economic growth. Now, if Trump is coming in with all these tariffs, there is going to be some uncertainty or potential downside risk to global trade, global supply chain. That is another measure that doesn't give us any confidence in really going heavy in ex-US equities just because they're cheap. So, and then that red bar chart is very interesting. Obviously, the World Trade Uncertainty Index, that's jumped as well for obvious reasons around Trump's tariffs. So if you want an indicator that you can follow, keep an eye on world trade volumes. If that starts to rally again, then there's definitely a case for ex-US equities.
All right, so that said then, what you've taken us through, how's that informing your investment decisions right now?
Well, we are taking selective opportunities in emerging market debt. Let's talk multi-asset strategy. We're taking selective opportunities in emerging market debt. That's where we've been. We haven't been in duration. We think there are opportunities in EM right now. So we are exposed, like I said, in our multi-asset strategy, we do have good, healthy exposure to ex-US equities, emerging markets being one. In a more direct way, direct equity strategies, there are still some very high quality companies outside of the US, but you have to be very selective, is what we suggest. So we still got a very much healthy exposure to the US for the reasons I've outlined. We're constantly taking profits off the top as markets continue to rally. But what we're not doing is making big wholesale shifts just based on valuations. I think you've got to be very selective in ex-US equities. Like I said, the key indicator that we're looking at is if we start to see good momentum in global trade and global economic growth, then we're happy to take a more higher weighting.
But as you say, so much uncertainty, and that will continue until at least Donald Trump assumes office mid-January. What's your view on China then? Obviously, the potential large impacts if Trump follows through on his threats there. But more broadly, what we're seeing with the latest data from China, still seeing that weakness there.
100%. I think overnight retail sales came out in China. Mind you, Europe's and UK's flash PMIs also came out, again in contractionary, being there for 3 years. So look, again, argues for that picture of exceptionalism to continue in the US. But more specifically to China, we do have a position in China. We've had a contrarian position in China. In the last 6 months, it's actually done really well for us. We did anticipate gradual stimulus package to start coming out of China, which it has. Still the recent announcement has been a bit of a bazooka. So our position in China is really playing that valuation disparity. So that's where we see opportunity. But in terms of a quick turnaround in Chinese prosperity, we don't see that happening. It's a big Titanic ship that's not going to be easy to turn around. Interestingly, I think Donald Trump may still want to extend an olive branch to China. The fact that he's invited him to his inauguration, which Mr. Xi probably won't take up, but nonetheless, I think he likes to do deals, and we are kind of playing that in a roundabout way through China as well. So we like China as a contrarian play, but you've got to be very active with that position.
And then how is that likely to affect Australia, particularly given the dominance of commodities and the fact that they've been under pressure?
Yeah, so look, we don't think China's motivation is around build to get out of this current rut, an economic rut. So we are still very much cautious on commodities as a simple beta play. We still got exposure to commodities, but they're selective commodities. So I think anyone that's expecting iron ore to rally back up to $110, $120 a ton, I think those days are probably something of in the past for the time being. So long story short, we don't think China's stimulus package is going to be majorly positive for Australia in terms of commodities.